So our next question comes from Parker V. Parker says, "Hi, Austin and Robert. My name's Parker. I'm 23, and I recently found your podcast. I've been binge listening for a couple days now, and it is fantastic. My fiance and I recently graduated college with master's degrees, and I have a job lined up that begins in August. My job, however, does not offer a 401k. My fiance is still actively job searching. We both have Roth IRAs with very little money in them. We were both college athletes, so we were lucky enough to escape college with zero debt and $58,000 in our pooled savings account. With my almost current salary and monthly budget, I believe I will be able to support us while saving just a little bit without having to tap into that $58,000 in savings. We would like to have the ability to put a down payment on a house in the next 3 to 6 years' time. What is the best way for us to allocate the $58,000 between an emergency fund, our retirement accounts, the stock market, and any other things that you guys can think of? And should we invest this amount of money all at once, or do we dollar cost average it over a period of time? Thank you guys for always helping your listeners out." What a great question, Robert. I'll let you kick this one off.
Parker, I think you're in a great situation. Here is what I would do. I would take the $58,000. I would leave enough for 3 months expenses in that hopefully high yield savings account. I would immediately get a public.com account opened up, get the Roth IRA set up, both for you and your fiance, because we want to get that tax-free growth in the future. So I would get that opened up, and then I would start getting that maxed out with the index funds that we like, those low-cost ETFs like VOO, VUG, QQQ. I'd get some money moving there as soon as possible, and then I would also get some money moving in cryptocurrency. You can do that anywhere. We like public as well. Buy the blue chips, the Bitcoins, the XRPs, get a little money working there as well, because we believe that cryptocurrency is going to do great over the coming years. But at the end of the day, the way I look at it is, if you're not going to buy a home for 3 to 6 years, I don't like the idea of the money just sitting in savings, even if it is high yield savings, because that's too long of a window to leave 5, 6, 7, 8, 10% on the table year after year. So that's why I would get the money working. You've heard me and Austin say it for many years now, or if you're new here, you may have not heard it yet, but you need to make your money work as hard for you as you work to get it. And that's a lot of money for you to have sitting in potentially only making 2, 3, 4% on it. So that's what I would do. Get the Roth set up, get a traditional brokerage account set up, get that money in and get it invested throughout these low-cost ETFs and cryptocurrencies to get you making a higher yield on your money in the coming years.
What a great breakdown, Robert. Parker, here's your play-by-play from someone who was in your shoes 6 years ago. First thing you want to do is completely understand exactly how much money you will be taking home on a monthly basis. Right now you have like a salary, probably, offer numbers, you got some stuff figured out from your job, but you don't yet understand yet after taxes and benefits and things like that, how much you'll be taking home. So your budget might flex a little bit, but you really need to understand exactly how much you'll be taking home, and make sure whatever situation you and your fiance are putting yourselves in when it comes to an apartment or where you're going to live or how you're going to fund your lifestyle, if that's commuting to work and how you guys are saving, like all these things, it has to fit within that monthly budget. Because if it doesn't, that's how people get themselves in trouble with credit card debt, tapping into savings, draining retirement funds, things like that. Do everything you can to understand exactly what your monthly budget is and stick to it. That's number one. Number two, Robert crushed it when it came to the emergency fund. 3 months of expenses is all you need. I'm assuming your monthly expenses will be about $5,000. So put aside $15,000 of this $58,000 into a public.com high yield cash account paying 4.1% APY. That's going to be the buffer between you and life. So when crazy stuff happens, you don't have to tap into your savings or cash out investments or anything like that to pay for it. You just use your emergency fund for that event. The next thing, Robert was completely correct. You want to get those Roth IRAs open and funded. You want to get, before you buy a house in 3 to 6 years' time, $100,000 saved and invested. We call it building your base, because this means that you now have $100,000 working for you, growing, compounding 5, 7, 8, 10, 12% per year over a long period of time, without putting all of that money instead in a single family home, which normally just turns into a cash money pit for when things go wrong, or maybe it doesn't appreciate as fast as you thought, and then the interest rate's too high and it's just a disaster. So I would make sure that you got the Roth funded, max that out every year, and then you'll have some more money left over. Make sure that you've already figured out when it comes to how much it's going to cost you to move to where your job's going to be. Maybe you got to put down a month or two of a deposit on your apartment. Maybe you got to upgrade some furniture. Maybe you got to do some things to get to a situation where you all are ready to start the adulting that is being a college graduate, which is exciting. But what I'm saying is make sure you've got that money saved and ready and allocated so you're not swiping the credit card because you're 23 and you think, oh, I'll just pay this off later, and you just find yourself in a mess. And then the last thing I want to encourage you to do is be very thoughtful as to how you actually go buy that first house. Robert and I talk about house hacking all the time. You guys are going to be in your 20s in the next 3 to 6 years, which means house hacking is definitely on the table for you. You should be able to do the 5% down Fannie Mae mortgage, which allows you to buy up to 4 doors, borrow up to $1.3 million, I believe, at that 5% down, whatever it looks like for you. So go buy a duplex somewhere in your town, make sure the numbers shake up and you're good to go. But that will be your first foray now into real estate investing. And once you live there for a couple of years and you're ready to actually buy your first single family home, you'll have 2 doors now, 2 tenants. You'll have it from one side of the duplex and the other, and it hopefully cash flows and everything's going to be great. And you guys will be off to the races being millionaires in no time. So Parker, congratulations on setting yourself up for such a wonderful long-term financial trajectory. Robert and I are rooting for you, and we hope that this breakdown will help guide you a little bit as to where you'll be going over the next 3, 6, 9, 12 years.
I love it. And the only thing I would add to it, for any of you that aren't living together but are looking towards marriage, the ultimate hack, because remember, once you get married and sign on the dotted line, all bank entities look at you as one. So the ultimate hack is, if you're not living together yet, both of you go buy a duplex. That way, when you get married, you have 4 doors, and then you can live in each one until you get married, and then use the income from the 4 doors to buy the primary home. Because I will say this until I'm blue in the face for the next few decades, I don't think anyone should save and buy their primary home too early and become house broke, because so many people think that is the next iteration in adulthood, is to go out and buy a single family home. I don't think it's a great move to start, especially as young as you guys are. So please look at house hacking at the very least. And for anyone else listening that's thinking about getting married in the next 1, 2, 3 years, think about going out and getting a duplex for each of you. So that way you start that marriage off with all of this additional capital appreciation and income from all the doors you'll already own.
Boom. Couldn't have said it better myself.